We had a recent guest, Marco Salmon from Harvard, on to discuss his research on how index funds incur what he calls in his paper adverse selection costs, and that's coming from rebalancing, index rebalancing into new share issuance when firms issue stock, IPOs, which we've already talked about, and then selling out of buybacks when firms buy back stock to match the index. How does Dimensional deal with things like buybacks and new share issuance?
Yeah, so the new share issuance is very much aligned with the asset growth exclusion. Because if a company is issuing a lot of new stock, then it's probably going to fall into that category of greater than 75% asset growth over the past 12 months. And so those would be examples of securities that we would just exclude from purchase because those stocks typically underperform in the months after that new issuance has occurred. And again, it's back to that kind of less cash for investors, all else equal, right? It's back to that concept. So that would be an example there, and I think that helps mitigate that issue. The other item, though, and I think this is important to keep in mind, is that we have a piece of research that was done recently which looks at either free float changes or shares outstanding changes for companies in indexes and what volume spikes look like around the time that those happen because of index activity, right? And what you typically see is, on the order of 10 to 20 times, like if you were to look at the closing volume over the prior, 20, 30 days before the corporate event, you typically see about 10 to 20 times that volume in the day of the event. So it's kind of like the index and then the index funds are doing it. That causes a lot of abnormal volume that can push prices. How much does it push prices? Well, in about the 10 minutes into the close, it pushes prices by, 3 to 5 basis points. That's a lot of push in 10 minutes. That's a lot of push in 10 minutes. So I think that the other aspect then that you have to keep in mind with these is not just its implication for expected returns, but its implication for liquidity and trading costs, because these types of events cause indexes on a frequent basis to reshift, to do a little bit of rebalancing to keep track of those changes in shares outstanding. And that can push prices up a little bit when they're buying and push prices down a little bit when they're selling. And that can be kind of a different form of reconstitution effect that's not as popularized and not as well known as stocks coming completely in or going completely out of the index. It tends to be a bigger effect for those stocks, but can be a bit of a drag on performance.
How do empirical realities like momentum, short-term reversals, and high securities lending fees actually affect the expected returns?
Yeah, let's define some of those, and so we're all on the same page. Momentum is the tendency of stocks that have outperformed over the past 12 months or so to continue to outperform, and stocks that have underperformed to underperform over the next few months. When you think about the securities lending fees, what our research shows is that when stocks go on loan at a very high fee, they typically underperform, especially in small caps, over the next few days. And you might say, why would that be? Well, if they're going on loan at a very high fee, somebody probably knows something. They want to short it. They're willing to pay a lot. And so that information is going to work its way into the price one way or another. And so that could be an example there. And so how these things work into the process is that you have your buy and sell, so what you want to buy and sell. But then there's the timing of when you want to buy and sell. And I think that's, again, if you go back to our baking analogy, there's no recipe that says this is the perfect time to buy and sell. So we ask ourselves the question, well, if there's 100 or 200 stocks that we want to buy on a given day, and we know that things like momentum and securities lending information is gone very quickly. Like a stock is in upward momentum for a couple of months and then it's not. Or a stock is in high securities lending for a while and then it's not. Or vice versa. Can we factor that into the timing of when we're going to buy the stock? We're going to buy them all the ones that we want. But as we have flows come in and go out, can we use that information to improve the expected returns over the short horizon so that we're not getting adversely impacted by some of these things over the short horizon, and that leads to better returns over the long pull as well. So you can think about it as our buys are overweight to upward momentum. They're not motivated by momentum, but they're overweight to upward momentum, and our sells are overweight to downward momentum. They're not motivated by downward momentum, but they're overweight to it in the way that we would trade. And the key piece of being able to do that goes back to something that we started with, which is the investment proposition. That prices change every day. Flexibility adds value. You can only do this in an efficient manner if you're looking to adjust the portfolio a little bit every day and you're not beholden to trying to lower your tracking error relative to some index. That's the only way that you can take these types of things into account, and incrementally they add value to the portfolio over time.
Have you guys modeled out the sort of expected economic benefits of doing these, the timing screening on these trades?
Yeah, and it depends. It's related to the turnover for the strategy. So for strategies that have lower turnover, it's going to be less. For strategies that have higher turnover, it's going to be more. That's just the way that it is. And so as you vary the turnover of the strategy, it's in the 5 to 20 basis point range, depending on the turnover when you put all of those together, the momentum screens, the short-term reversal screens, the securities lending screens. That's kind of what it may add over time is kind of some estimates. Again, not super precise. It depends on the strategy, but they're pretty reasonable estimates.
I want to go back to something you just said, Gerard. You talked about how expensive to borrow stocks have lower expected returns, yet getting sec lending revenue is a good thing. How do you balance that off in a portfolio?
Yeah, when something goes on loan at a high fee, our view is as follows. If somebody knows something and it's material to the company, it's going to be reflected in the price sooner or later. Should we loan somebody a stock to get it reflected in the price sooner? If they're willing to pay us so that we get paid when the price goes down, let's do it. We're not going to buy any more of it. So it's excluded from purchase while it's on loan at a high fee, but let's get paid while that information goes into the price of the security. And it's interesting because depending on the time period that you use, the data set that you use, the amount of underperformance is quite similar to the amount of lending revenue that you can get for the security. And so it kind of can be helpful for the overall portfolio. So we're not going to sell it necessarily. We're happy to keep on getting the lending revenue. And then we're not going to buy any more of it over time. I think, the one classic example there is GME, because when that went through the roof, I think that the annualized rate on that loan that we were getting for GME in the portfolios was like over 10%. It was giving a lot of securities lending revenue. And we had about $60 million worth of exposure at the beginning of that January at the GME globally in our portfolios across all of our strategies. And by the end of the month, we had $1 billion worth of exposure to GME. We didn't buy any more, but we had $1 billion worth of exposure because of how much it went up. And we sold it all at that point because it was a stock that was in small cap portfolios, value portfolios, micro cap portfolios, and it was a large cap stock. And so there's an example of we were happy to have it in while it was giving the lending revenue. When it started to change characteristics so quickly, we were able to react. So we turned all of those paper losses into our paper gains into real gains for our investors. And when you look at the difference to indices held it up and they held it down. Markets change every day. Prices change every day. If you're not reacting every day, you're going to leave money on the table for your clients.
But you're using information you're getting paid to have, which is so interesting.
Yep.
Right?
And it's quite an opaque market too. If you're not in the market, you may not know the information. Because a lot of the short interest in real-time information is just very restrictive. You can't really see the short interest in real time. So it's kind of a proxy for that.
It's really interesting.
Yeah, that is an interesting one. Can you talk about the main ways that trading costs affect net returns?
Yeah, this is another good one on the kind of implementation cost side of things, because trading costs, there's explicit costs like the commissions or whatever it is that you might be paying. But then there's bid offer spreads and there's price impact, which are implicit. And the interesting thing about trading costs is that they don't go into the expense ratio. They come out of the NAV. So unless you have a process to ask the manager about their trading costs, you don't know what they are. The other interesting thing about trading costs is they're built into index returns because of the index managers. So trading costs are tricky, and it's important to kind of manage them well. So how do you manage them well? Flexibility is your friend. How you manage them well is that you have flexibility on what you can buy or sell on any given day. And how we do that is that a portfolio manager may generate a list of order candidates for trading on that day based on the portfolio on that day. I might say, here's $10 million worth of orders, but I only want to execute $5 million. And then the trader has flexibility on that day to do what we call participate, don't initiate. There's a lot of market volume that happens. Last year, if you look, over 800 billion US dollars was traded every single day in markets around the world.
Wow.
There's a lot of volume that happens.
Wow.
So if you participate, don't initiate, you can be part of that flow, never move prices, and that can be very, very helpful to the end return for investors because you're leaving less money on the table as you try to implement your strategy.
And how significant are the magnitudes of trading costs?
Yeah, it can vary. So we do a whole ton of experiments on trading costs, and we have a lot of different charts that illustrate it in different ways. But one of our charts, we call it the lollipop chart because it's all these little straight line with a little circle on top. But it shows US large caps, US small caps, non-US developed markets large and small, emerging markets large and small. And what you see in that chart is we try to estimate our relative price advantage to others in the marketplace trading. So what do? We run a set of experiments where we look at what we traded on a given day, so the actual name that we traded, the amount that we traded, and then we say, if we were to trade those and use other people's trade prices, because we sign all the trades, we use an algorithm to sign the trades, whether it was buyer initiated or seller initiated, what would it have cost us relative to what we executed? So we're looking at how others trade relative to how we trade, and we're saying what's the price differential. And in US large caps, it's like 5 to 10 basis points, and small caps is 10 to 20. When you go outside the US, then you're in that 20 kind of neighborhood, and when you get to emerging markets, it might be as high as 30, right? That differential, and that means buying lower, selling higher than others. And then how that impacts your overall returns depends on the turnover and how much trading you're doing. If you're doing very little trading, then it's not as impactful. If you're doing a lot of trading, it's more impactful. And so I think that kind of gives you a way of understanding the trading costs relative to what else is going on in the market at that time.
So those basis point figures were dimensionals per trade price advantage over competitors that you're measuring?
Yeah.
Okay. Yeah, makes sense. You mentioned this being less of an issue for lower turnover funds, but we also talked a little bit about the price pressure on index fund reconstitution or index changes. How much exposure would index funds have to trading costs?
Yeah, the index reconstitution effect is very well documented. And what is it? It's when a stock is added to an index, then the market knows that if that index has a lot of assets attached to it, then the managers who are trying to minimize tracking error versus the index are going to have to trade a lot of that stock, buy a lot of that stock on a very specific day. And if a stock is deleted from an index and there's a lot of assets attached to it, then the reverse is going to be true. They're going to have to sell a lot of that stock on that particular day. Now, the market is happy to provide anyone a service as long as the people in the market providing the service are getting paid. And so how do they end up getting paid? How they end up getting paid is what you typically see is you see a price ramp up in excess of the index return for stocks that are going into the index, and a price decline below the index return for stocks that are coming out of the index. And that typically tends to reverse after what's called reconstitution day, when all the managers trade in the index. And so then if you look at that, we have a number of papers on this that use very recent data, the past 10 years, to try and measure. And for those pure additions and pure deletions, and that's a subset of index turnover, it's not all index turnover, a subset of index turnover, then you find that there's about a 4% price run up in excess of the index return for the stocks coming in, and about a 4% underperformance for the stocks going out. That reverses. So what does that mean? That the index itself has the trading costs of the index managers built into its return. You can nail the index. That does not mean that you've had zero trading costs, because your trading costs have been built into the index return. You'll never ever see it if you don't understand where to look. One of the best examples, I think, was Tesla when it went into the S&P 500. And that was that December 2020 or was it 22? Maybe December 22 or 2020. I don't remember which year, maybe 2020. In any event, that was one of the biggest additions to the S&P 500. And we have a strategy here in the US that's a large company portfolio that looks a lot like the S&P 500, but we don't do exactly what it does. And we delay sales or purchases or we go early when there's a stock coming in. And we did that for Tesla on that particular month in December. And that strategy outperformed the index by 8 basis points in that month. Most of it because we chose to include Tesla at a different time than the index did. So that gives you a sense of how that kind of impacted the index returns itself in that given month. 8 basis points, by the way, is like 4 times the expense ratio for most S&P 500 index funds was spent in a month. But even then, if you look subsequent to that, Ben, like Tesla has changed the number of stocks that have been included in the index multiple times. And each one of those, you see little price pressures around when that occurs. So those things are built into the index returns. And so then it's kind of what people often refer to as the hidden cost of indexing. It's not in the expense ratio, but it definitely impacts the returns.
Just looked it up. December 21st, 2020 was the date. Tesla
2020,
joined.
there you go. Yeah.
So you mentioned expense ratio, and I think I know your answer to this question, but I have to ask it anyways. Fees are important, of course, and paying attention to fees are important. But do you think there's currently way too much emphasis on fees relative to these other components of net returns?
I would say yes, and I agree, fees are important. And if you look at Dimensional over time, whether it's our Canadian fund lineup, whether it's our US fund lineup, or OIC lineup, or USU lineup, or trust lineup, you've seen that we've reduced our expense ratios over time, both the management fees and the other expenses. And we've kind of a commitment to doing that over time, and I'm sure in the future we'll continue to do so. We look at that ongoing and make sure that we're competitive with what's out there in the marketplace. But I think that there's a whole concept of value for service. And value for service is something that you have to have expertise to make a good assessment around. Are you getting value for the fees that you're paying? Are you getting excess returns for the fees that you're paying if they're in excess of the index? You look over the past 20 years, over 80% of the Dimensional funds here in the US that have were around 20 years ago, they're all still around today, by the way, have outperformed their prospectus benchmarks. That's a hell of a number, much larger than the industry. 100% survival, where the industry is about 50% survival, and over 80% outperformance, where the industry is like 14, 15, 20, right? And it's about doing the things to control what you can control. And so I think that for folks, like all we ask is give us a chance to explain why we think all of these things are important, and hopefully we can convince you that we're giving you value for service, because just like you don't want to put your investors or your clients in $100 skis, not necessarily do you want to put them in the cheapest investment product that you can find, because that can be accretive to value over time. And I'll give you a couple of examples there just to illustrate. One long pull example and one kind of recent. We've had a strategy in the US for over 40 years, and it's a small cap strategy. And it's outperformed its prospectus benchmark, Russell 2000, by about 1.5% annualized compound return difference over a 40-plus year period. Well, what does that mean in terms of returns? We say the market about 10% return. Means your money doubles every 7 years. Not bad. If you can take that 10 and turn it into 11 or 12, your money doubles every 6. So over a 42-year period, you got double the money from what you started with. And that 1.5% is net of all fees and expenses, where there's no fees and expenses extracted for the index. Right, that's an example. And when we break that down, that's a small cap strategy. So some of the things we talk about are probably bigger. But, around 50 to 100 basis points came from the universe definition. All the things that we were talking about that are very important for small caps. Some came from momentum screens. Some came from the high asset growth exclusions. Some came from the small low profitability growth exclusions. They all came from different sources that added up to about that 1.5%. And different things were important at different times because the strategy hasn't been the same the whole time period. It's always been a small cap strategy, but we've gotten better. As we learn more, we improve our strategies. So our commitment is to get better. At the same time, the expense ratios are coming down. So you're getting a better product for less, which I think is pretty good. The other example I'd use, Cameron, is over the past year, if you look at 2024, we've won in 2024 about $18 billion in new mandates from institutions that were leaving indexing behind and going to our approach. So they weren't asking for a lot of overweights to size value profitability. They were asking for build us a better market portfolio. And they used some of the existing mutual funds that we had around for a long time as examples. And the components of net return conversation was what was starting to change their mind to get them to dig deeper. Because there was a big trend in the institutional marketplace for a long time, where it's get your public market exposure at as low as expense ratio as you can and spend all your time in the private market stuff. And I think that hopefully we've gotten a bit better at explaining the benefits of our approach and the value for service at Dimensional. But I also think that the market is getting to see that due to their own experiences of what they've experienced, these large institutional investors, in implementing these indices in-house, of what some of the frictions are and how they leave some money on the table. And they're willing to go and increase the management fee they're paying because they feel that they're getting value for service.
I find DFUS to be a fascinating product because it's kind of what you just said. Take the market and do it a little bit better. Addresses a lot of things we've talked about. Can you say how much of a difference in net expected returns you would expect between it and a total market index fund? And DFUS has a 9 basis point expense ratio, I think, and say an index fund with a 3 basis point expense ratio.
Yeah, about 5 or 6 basis point difference in expense ratio. If you look at that fund, and actually that fund, Ben, is part of an overall series. We call it the Market Series here in the US. So we have 2 US funds in that Market Series and 1 non-US developed and 1 emerging markets. And they all have very, very kind of, I would say, market-like characteristics. So they're not doing a lot of small cap and value and profit, but that's not what they're doing. They're doing more of the things that we talked about, some exclusion, some implementation, and so on and so forth. And they've all been live since January of 2021 because we started our ETF business, standalone ETF business here in the US in November of 2020, and we launched 2 in November and 1 in December. So they've all been live since then. And I think that the one that you mentioned, DFUS, is probably on the order of 50 basis points outperformance since then. And the ones outside the US are even higher. They're, 50 to 100, somewhere in that neighborhood. I would say that's a little higher than I would have expected, to be honest with you. I think that we've just had a good run. Things like small, low profitability growth and high asset growth have had really poor performance over that time period. So not holding them has been very, very helpful. But I wouldn't be too put off by 20 to 30 basis points in terms of performance difference net of differences in fees and expenses. And especially after taxes here in the US in particular. Like I'll give you an example. That REIT exclusion makes a difference to the after-tax return. But then things that we do around how the timing of when we buy and sell securities, when they're paying a dividend, to make sure that the percentage of qualified dividend income is higher for our strategies relative to some of our competitor index funds, I think is also an advantage. So after-tax returns, we need 30 basis points, some number like that. And for 5 basis point or 6 basis point expense ratio differential, we think that's a pretty good deal. And so it's kind of like, back to our baking analogy, right? We're all making ciabattas here in the sense that we're making portfolios that look like the market, smell like the market, taste like the market. They don't have a lot of differences. When the market's up, you kind of know what your portfolio is doing. But how do you squeeze that little bit out, even though it's a broad market portfolio? And all of the things that I mentioned that are very systematic, they're all rules-based. We improve over time. They're all very, very rational. It's not like we're doing outlandish things. We're just using common sense and how to approach the market. They've all added value over time. So I think that, expected outperformance, I'm always reluctant to put a number on for a strategy because returns are very, very noisy. So we've had a good run. We may have disappointing outcomes in the future, but I think over the long pull, 20 to 30, some number in around there, which could make a difference. Makes a difference to your long pull wealth.
I think I just ran the numbers for DFUS since June 14th, I think, is when it listed as an ETF, and then compared that to a total market index fund. That it's actually closer to 100 basis points annualized since the conversion.
You go. Good, yeah. And it's interesting, the conversion itself. And this is something that I think, is a bit of a challenge for financial professionals, but it's not an insurmountable one, which is because that fund, that was a mutual fund before converted to an ETF. And it's been around since maybe 2001 or so. So it has a long track record. but it's done slightly different things over that time period, which is why a conversation with the manager is important to understand its relative performance. Because it was a tax-managed mutual fund back when it launched. And so we did things around delaying the realization of long-term capital gains, trying not to realize any short-term capital gains, some things around how we manage the dividends, our exposure to companies paying dividends. We had different types of security caps. We didn't have the small, low profitability exclusions at the beginning. We didn't have the high asset growth exclusions. And so when you look at it now versus its long pull history, it's a little bit different than it was then. And that's why a conversation with a manager, when you're trying to understand any fund, ours or anybody else's, I think is appropriate for a financial professional. But I like to tell a story. And so I have a 10-year-old daughter, and she's very active. She's into all sorts of things. But one of the things that she likes to do is Brazilian Jiu-Jitsu. And I don't get to go to all of her events, but I do get to go to the jiu-jitsu events because they're on the weekends and her training is on the weekend. So we go on a Saturday morning. And I don't know if you know, in Brazilian Jiu-Jitsu, they have what's called, their black belts are called professors. And every morning before they start class, there's a little life lesson. And some of them are actually really good. I listen, I take notes. And so one of these life lessons was around, the professor said, okay, what does practice make? And one of the kids put up their hand and said, perfect. And he goes, no, practice makes progress. You can never be perfect. And it was a really nice kind of a life lesson that we embrace here at Dimensional, which is we get better all the time. And so that is reflected in the strategies all the time. And so our strategies aren't identical through time. The main themes of the strategies are very, very similar, but how we implement gets better because practice makes progress. And that's what we're trying to do day in, day out is get better at how we implement.
Amazing. So you've been sharing information over the past hour that's very interesting. And I'm curious how you pull this all together when you build portfolios that have the tilts towards the higher expected returns.
Yeah. You know, we've talked about portfolios in the market series. So now let's say we want to have a bigger tracking error budget. And so what comes into play? All the things that we just talked about still work. But now we're going to do a lot more weight deviation relative to the weight in the market. So in those market series, so what you mentioned, DFUS, you look at the individual security weights, they're very close to their market cap weight. But in Canada, we have a lot of cores, we have a lot of vectors. And so the cores now will take much bigger differences in terms of their weight relative to the weight in the market to pursue another area of value add, which is overweight the highest expected returning securities in the market. And I think that's a kind of another tool or lever that you have in your toolkit. And you just have to decide how much tracking error can you take as an investor. Because the more tracking error you take, the worse at certain points in time you will feel. In the long pull, we think you're going to be happier, but you have to be able to live with the unhappiness to get the long pull happiness, because the more tracking error, the bigger the chance for underperformance, and that underperformance will show up at certain periods of time. That's just how it works. And so when you look at the core to the vector, it's kind of a trade-off of how different you want to be for your expected outperformance. So in core, we often quote like 1 to 2% expected outperformance with 2 to 4% tracking error. Like that's what we would quote. And vector, we might go 2 to 3 with 6% tracking error, something like that. So we go a little higher. The example that I use for vector, because vector now is kind of a market portfolio, but not a broad market portfolio, in that it's excluding more stocks. Right. So the stocks that would be included in a core are pretty much the same group as would be included in the market series that we were talking about. But vector, now you're going to exclude about 40% of the market cap. And so the way that I often describe it is if you look at the US market as the end of last quarter, the profitability, so that's aggregate profits divided by aggregate book value, about 60%, right? 0.6 profitability. You look at valuations, and they change, but as the end of last quarter, first quarter 2025, you're looking at price to book ratios like 4.5, PE ratios, 20 to 25. So people will say, yeah, very high valuations for the US market, but the US market has about twice the weighted average profitability as developed markets outside the world, because developed markets outside the world are about 0.3 weighted average profitability and about half the valuation. So it's not clear that the US was so much higher value because of the weighted average profitability. So you say, what does value do? Value would typically take that profitability and cut it in half. So a value strategy in the US at the end of the last quarter would have taken the profitability and turned it down to about 0.3, and would have taken the price to book ratio or price earnings ratio and also cut that roughly in half. So the vector, what it tries to do is kind of have a better blend of value and profitability. So you look at the profitability of vector, it's about 0.6, about the same as the US market. But then you look at the valuation ratio, it's about 30 to 40% of the US market. Not quite like value, but getting there. So what's it doing? It's focusing on those stocks that are either high profitability, deep value, or both high profitability and value. And so between the core and the vector, you can put those together to get a very tailored exposure to these size, value, profitability premiums, which also then contribute to expected outperformance over time.
Yeah, super interesting. That idea of making a value portfolio, and then you can see it if you look at any product, and its profitability just drops. But then seeing how, like the vector funds, you get that value, but your profitability doesn't drop below market. It's cool to see. It's cool to see the implementation in action when you look at product characteristics.